Welcome, everybody. I want to welcome all of you here today as we talk about the various tax issues for global and workers, remote workers, and as they pertain to individuals and to their employer. And so we have a great panel today that we're going to, I'm going to introduce. So first of all, I'd like to introduce myself. My name is Jared Johnson, and I am out of our Eide Bailly Salt Lake City office. I am part of our international tax team in our national tax office, and I oversee our global mobility practice and really all things individual related as they pertain to international tax. So we can really help with companies as they navigate with the global workforce, and we can also help one-off individuals that may be entrepreneurs or just an employee overseas, an expat somewhere in the world. We can help with a lot of their tax compliance and tax planning. You name it, we can do it. So I've been with Eide Bailly about 8.5 years now, and I was formerly with one of the big four firms. So anyway, I'd like to have Gabe and Lucas introduce themselves. And Gabe, do you want to start off and introduce yourself?
Sure, thanks, Jared. Hi, everyone. Gabe Schreiber. I'm a senior manager in the National Tax Office. My specialty is international tax, but more for the entity side. So while Jared covers most of the individual issues, my background and practice area is more focused on the entity considerations of expansion globally. Work with a lot of smaller businesses as they move into the international tax world for the first time, whether that be having employees or contractors located around the world, whether that be selling internationally or forming an entity and opening an office in another country. Happy to work with you through the considerations, partner with our local offices to make sure you get good advice on both sides of the issue. And I've been with Eide Bailly for a year and a half now. And prior to that, I spent a decade with one of the big four firms doing international tax. So happy to be here and talk with everyone today.
Thanks, Gabe. Lucas, would please introduce yourself?
Yes, good afternoon, everyone. I'm Lucas Loss. I'm also a senior manager. However, I work more on the global mobility side with Jared. So I assist individuals that either go outside of the US on international assignments or come to US on international assignments. And in my previous life, I was with Big Four for about 15 years. And where I gained experience with small mobility programs, the ones that are just starting out, as well as with big global mobility programs that were well established and had hundreds of employees on international assignments.
Thank you, Lucas, and thank you, Gabe. And we will move on to our next slide. So first of all, before we get kicked off on this topic, a lot of people will ask us, well, Eide Bailly is not a global firm, so we don't have firms throughout the world under the Eide Bailly umbrella. So a lot of people will ask us, well, how do you accomplish your work outside of the US for remote workers? And the answer to that is we belong to the largest independent network throughout the world of accounting firms throughout the world called HLB. And so we partner with a lot of regional type size firms throughout the world that have expertise in these areas to help remote workers or whatever international work that we need to accomplish overseas. And it's a very great network, and we're very active in that network. And we as a result of that partnership of that independent network, we act like a global firm. So anyway, so in my role in global mobility, I get the question hit up on me very frequently, and more so since COVID. But even then, before then, the very frequent question I get is well, Jared, we're a smaller company, and we're looking to expand outside the U.S. We need to move employees overseas. How do I pay them? And so a lot of people will start with that. Since COVID, that's changed a lot, and a lot of our experiences as the employers are now coming to us and saying, hey, we have an employee that he has family in Spain and they just want to go work in Spain. What do we do? And how does that cause issues? Really, the world is getting smaller, and more people are wanting to have these global experiences and work remotely wherever they may be. And the term for this is called digital nomads. And so there's a lot of digital nomads that will just basically go out and they'll work wherever there's a Wi-Fi connection. And that is great. And it adds a lot of flexibility. And I'm going to kind of move on to this. This is what the market is like right now in this. Like I said before, kind of before COVID, a lot of companies were looking to expand their workforce globally because of global expansion for their organization, right? They wanted to move somebody, and so you had these typical type of assignments. Well, now they're becoming all sorts of different assignments. You have assignments where you want to move someone overseas to grow your organization. You now have individuals that are coming to you that want more flexibility, and they may be a high performer. And you're like, well, what do I do? They want to work in Spain. I want to accommodate them to keep them happy. How do we accomplish this as an organization? And so these types of the marketplace in global mobility is really changing, and it's changed really quickly since COVID. They're no longer just special programs where, these global mobility programs used to be where they were set up to develop critical talent in certain locations of the world. And it's not like that anymore. And so a lot of organizations are now having to pivot and try to make changes in these areas. And so this is where we're at, right now as a marketplace. After the pandemic, during the pandemic, there was a lot of, people were just moved wherever, they went home, a lot of them, right? And so tax jurisdictions were very lenient on this, and because it turned the world upside down. And a lot of times what remote workers, what people don't understand, they're generally taxed in the location where they're performing the service. And Lucas will get in this in just a minute. They're typically taxed in the location where they perform the service, not where their payroll is run. And that's a common misconception out there for smaller organizations. They think that, they're on US payroll, so all I have to do is worry about US withholding, when in fact they've been living and working in Spain. Well, Spain doesn't see it that way, and that's the rub. And so we since the pandemic, these employees, like I said earlier, they're demanding more flexibility in these work locations. They're thinking, well, let's go from these high tax jurisdiction to low tax jurisdictions. There's just all sorts of things that they and the organizations are trying to do, and the pandemic really had a huge effect on this. And it like I said at the beginning, jurisdictions at the very beginning were very lenient, and they gave a lot of they came out with certain numbers of days that people could waive in each country from trying to avoid meeting residency in that country. Like the US said, we'll waive up during a certain period of time during the pandemic, we'll waive 60 days of travel into the US that won't count toward days of determining residency. Well, not only did a lot of companies struggle through the pandemic, but a lot of tax jurisdictions did as well. And now all of a sudden the pandemic's over and you have a lot of tax jurisdictions that are like, hey, we're not so lenient anymore. We're hurting. We're looking for opportunities to raise revenue. So they're going after kind of this low-hanging fruit of people that may have lingered in these countries for longer than they should have, and longer than what their previous exemptions allowed for. And so they're coming out aggressively with audits. They're looking to raise revenue by different means of raising, or look the way they calculate gross tax receipts and different things like that. The state and local has a lot to the state and local tax area has also has gone through a lot of change in this area as well. It's not just international tax, but state and local taxes. There's a lot of considerations there too, as you have employee workforce transferring between states. And so lots of different things to consider here. Lucas, I'm going to turn the time over to Lucas to talk about some of the different taxes.
Thank you, Jared. Appreciate it. So as Jared was saying, the current global mobility market is very active, and the types of assignments that we see are very different from the ones we might have seen in the past, where they were in the past, the assignments were very formal, and now it seems a lot of travel is informal and happens a lot quicker than it did in the past. So with that, when we talk, these are the main items that we wanted to bring your attention to today: the individual and payroll tax, entity level tax, where Gabe is going to talk about the corporate side of it, and what to look out for in that respect. And then we'll close up with the global mobility considerations that have to do with setting up a global mobility program, what items to look out for, in that as the assignments requires, as noted here, both individuals and businesses to navigate various tax issues, whether it be compliance, as well as risk management. Both employee and the employer must work in tandem, really, to ensure the success of any assignment that happens. So with individual tax, as we are aware, there are a number of different taxes the individual is exposed to while on international assignment, or even just at home. It would be, and for the US in particular, as we're in the US, there is a federal tax, state tax. There could be municipality tax or city tax, depending on your location. Other things to consider, for example, somebody going outside of tour on international assignment outside of the US, taxation by foreign jurisdiction. Will I be double taxed if I go to Spain? As Jared mentioned earlier, somebody wants to work out of Spain. How is that going to work? My withholdings in the US will continue, and then I have to pay tax in Spain as well. That doesn't make sense. That's where the tax treaties come in, and the US does have a tax treaties with a number of countries that allow provisions for elimination of double taxation, allow individuals to claim foreign tax credits for the taxes that they will pay or that they have paid in a foreign jurisdiction. Other taxes to consider: wealth tax, social tax, estate, and gift. Again, depending on the locality, all of these or some of these may be applicable to the individual, and as well as the foreign pensions and foreign bank account reporting. Foreign pensions is a really big topic that became really more scrutinized about, I want to say, 10 to 15 years ago by the United States IRS, where individuals that were on international assignments would participate in these foreign pensions. And a lot of foreign pensions are not considered qualified deferred compensation plans from the US tax perspective. So in many situations, the growth in value of those plans could be subject to US tax. But again, we have to look at the US tax treaty with a given foreign location. So there's a lot of planning that could be done around that. And as well as the foreign bank account reporting. We're probably all familiar with Form 114, report of foreign bank and financial accounts, that essentially anyone that works outside of the US is most likely filing if their total combined accounts, foreign accounts, are more than $10,000 at any point during the year. So it's all of these items that will impact the individual that plans on going on international assignments. Now, residency is probably it's a good starting point, as it's one of the main issues that individual faces when working remotely, is establishing a residency in a foreign country or in another state. And why would residency be important? As Jared mentioned, the remote workers are subject to tax at the place where they perform the service versus where their payroll is. So with that, individual must be aware of where their effective residency is, tax residency. Also, with as a U.S. resident, U.S. residents are taxable, or U.S. citizens rather, sorry, are taxable on the worldwide income, earned and passive, regardless of where the income is earned or regardless the source of that income. So U.S. residents are also subject to a number of international reporting to the U.S. government. As I mentioned, the foreign bank account reporting, as well as reporting on other foreign trusts, or if they participate in foreign corporations. Those are also required to be reported on the U.S. tax return. So it is essential to determine one's residency during the year and where they would be subject to tax. Okay. Right. As I mentioned, for a U.S. individual, their residency would be the regular place of, or principal place of business. And if the individual has no place of business, then their tax home will be considered their regular place of abode, so where they live. So that would essentially be for the remote workers. It's probably the easiest way to identify that. The tax home rules and away from home rules, they do have a larger impact also when relating to expenses that can be claimed for individuals. That would also relate to a short-term assignment versus long-term assignment. When it's determined if it's a short-term assignment, different type of expenses can be claimed versus long-term assignment. So again, it is important to, at the onset, at the start of the assignment, to determine what type of the assignment the employee will embark on, and go through all these items versus trying to play the catch up once the assignment has started. There's potential for a lot of savings. So we do ask that you consult with your trusted tax advisor, although we do know that that's not always possible, as the business unit is a lot of times is requiring individual to go on the assignment prior to anything being put in place in terms of policy or assignment letter. So we do understand it's not always perfect, but we are here to help. If you have any questions, obviously we'll be happy to assist with that. Again, going back to the U.S. expatriates, when they start the international assignments, there are certain provisions allowed under U.S. tax law that will eliminate double taxation. One of them is called foreign earned income exclusion. Here it's noted as 9/11 exclusion, as well as the foreign housing exclusion or deduction that one can claim in order to reduce their taxable income. Also, foreign tax credits for the taxes that one pays in the foreign jurisdictions. And as noted here, the US does have tax treaties with over 55 countries. The filing deadlines for the tax returns for the US individuals will change. US individual does have, US citizen living outside of the US does have an automatic extension until June 15th to file their US tax return, although payment of tax is always due April 15th. And there are also additional extensions available. You're probably aware of them. One of them just passed. It was October. It's usually October 15th, and unless it falls on the weekend, then it's pushed to the first Monday. In order to qualify for the foreign earned income exclusion, there is one extension that goes all the way through January 30th of the following year. Should one be required to file a bona fide resident, or should one require bona fide residents to qualify for the foreign earned income exclusion? Now, in addition to the federal residency, there are also obviously state residency issues, and depending on the state, state residency may continue once individual starts the international assignments. It all depends on domicile rules of a given state, so those must be examined carefully. And again, that's something that can be addressed in the assignment policy that the company has for international assignments, or in the assignment letter that's presented to the individual. Depending on the state, some states will allow foreign earned income exclusion. Some states will also allow foreign tax credits, whereas others will not. So again, it's really important to examine that prior to the start of the assignment to ensure that that individual, the employee that's on international assignment, would not be subject to any adverse tax situation, or we can potentially minimize that by doing planning prior to the onset of international assignment.
Most of this presentation is targeted at the individual tax considerations, but there are entity level tax considerations that you should be aware of and things to keep track of. As we talk about employees, nomad workers or employees wanting to work in a country other than their initial employment country, it can create issues for the company as well. And so we added some entity considerations so that they're on your radar and you're aware of them. So let's get going. Some things to consider is, the way that countries generally tax income of a company is you have to have a taxable presence. The country with which the activity is occurring in, the taxable presence will generally be determined under their laws, not US law. And so it's really important that you have an idea of where you're planning to expand or potentially hire employees so that we can have a conversation with that country and a tax advisor there so we can talk through the considerations. But some things to think through are whether or not we have a tax treaty with that country. The IRS, there's a webpage out there that lists every country that the US has executed a tax treaty with, because the tax treaty will generally provide a little bit more leeway in the level of activity that you can conduct before you create a taxable presence. The term permanent establishment is an international tax term that is the level of activity that you need to have before you become taxable in that other country if we have a tax treaty with that country. So you'll often hear people refer to PE or permanent establishment if there's a tax treaty. If there's no tax treaty, the threshold for taxation is much lower and it's just a taxable presence. Some things to think about as you plan the expansion is what activities are going to occur outside of the US in both the short and the long term. This can include having a shared service center, like a back office. We've gotten a lot of calls recently about companies hiring back office support in the Philippines. India is another country where a lot of companies have hired back office support. Or is it going to be more of a customer facing role, market development, sales, services after the sale, or an e-commerce type business model? The answer to those questions will greatly impact how you will be taxed in that other country. So it's important to understand that as you think about expanding. So taxation in the US is very dependent upon your structure here. Are you operating as a C Corp or an LLC taxed as a corporation, or maybe you're in a flow-through structure, an LLC taxed as a partnership, or an actual partnership? Those are all, every one of those structures can have a different answer for US tax purposes. And so it's really important to talk to somebody that can advise you both on the foreign tax considerations and how that activity will be taxed in the US, because we have some anti-deferral rules. The last bubble on your screen, the subpart F and GILTI rules, those are anti-deferral rules where income of a foreign corporation may be subject to US taxation, immediate US taxation. And so the type of entity you are in the US will impact that taxation. Some other things to consider are transfer pricing. Transfer pricing is the pricing of intercompany transactions between related parties. Most taxing jurisdictions follow OECD guidelines. The US has their own guidelines. They're very similar. Generally, it just requires related parties to contract as if they were unrelated. And so transfer pricing is always something that we talk about and may be relevant for you. IP use or transfer is very important. You know, what is the foreign company doing? Are they utilizing brand or know-how in the foreign jurisdiction? If so, there may need to be a royalty. And if there's withholding taxes on that royalty, there's a lot of considerations that go into that. We also want to protect the economic rights of the IP in the right jurisdiction, and transfer pricing and royalty charges can go a long way in protecting the economic ownership of the IP. So kind of touched on this in the last slide, but what type of US entity do you have? What are your plans to repatriate profits? What functions and risks will be undertaken outside of the US? And will you be using technology or know-how developed in the US? Those are all questions that relate to the last slide. So what type of entity, as we said, you know, corporate or pass-through? The LLC is a very common entity here in the US, but generally foreign countries can have issues with the LLC, and specifically Canada does not. LLCs don't generally work very well investing into Canada. Other countries like the UK can have issues as well. So it's good to be ahead of these items so you can plan appropriately. The repatriation of profits or reinvesting of profits can impact taxation drastically. Functions and risks. So as part of transfer pricing, we usually do a functions, assets, and risk analysis. We call it a FAR analysis. And those three things, what functions, what assets, and what risks are being undertaken in each market, will drive the profitability in that market and impact the transfer pricing. And then we talked about technology already, so I'll skip that one. So the entity level tax considerations, again, gets back to, you know, doing business in a foreign country, having a PE, and if the foreign country is going to assert tax on the U.S. company or the U.S. shareholders, you know, is there a foreign tax credit available to help alleviate double taxation? This is where employees working remotely can create a taxable presence in that other country under these concepts. These concepts are similar to U.S. state nexus concepts, but they're different and they depend drastically on the foreign country's interpretation of the activities and the laws. And so it's really important to talk to both countries. As we said, income tax treaties can provide for additional activities before the taxation threshold is crossed. And some countries have relaxed these items to sort of recruit workers to their jurisdiction. I know, for instance, countries in the Caribbean, like Barbados, have at times relaxed, you know, these types of tests to induce employees to come work down there so that they will spend money in the economy and help, you know, local businesses in those countries. Still, even with these relaxed measures, it's very important to talk to both, you know, someone like myself and Jared, and then someone in Barbados to make sure that we are fitting within the planned relaxation and that there's no unexpected consequences. Some non-income tax and other issues to consider. In the US, we have sales and use tax. In the rest of the world, they have a value added tax, a VAT or a GST, which is very similar to a VAT. So having an employee may not create a VAT issue, but certainly expanding, importing goods, providing services can. There are also social taxes that, you know, exist if you have employees in other markets. There's regulatory requirements. Do you need to register your entity? What employment law exists, especially in parts of Europe? Labor law is very different than the US. And it's very important to understand if you're subject to that. Then there's obviously work visas and work permits. Certainly want to make sure your employee is in the country working legally and not there on a tourist visa for an extended period of time doing work. Countries sometimes don't look too kindly to that. There's other licensing and regulatory considerations that may apply, so it's always important to think about other issues besides tax, which we can help talk through as we work through that. So this is sort of a summary slide, and I think Jared might reference it here in a minute as well. But the issues to think about are sort of corporate tax or entity tax issues, transfer pricing for intercompany agreements, even if it's just a recharge. And then we've got regulatory issues, visa and immigration and employee tax considerations. And those are all things you should think about, you know, as you're considering having employees in other markets.
A lot of people wonder what is global mobility. It's kind of a terminology used by organizations to manage a global workforce. And as Gabe and Lucas is demonstrated, there's a lot of individual and entity complexities that revolve around having a remote workforce. I think in today's day and age, you hear about it, you read about it in the newspaper about how easy it is for individuals to go work overseas or wherever in another state. But what's being overlooked are the complexities that the organization has. And that's where I was just going to go back. Gabe was referencing to it. Like, so this is an overview of some of the corporate complexities. You know, you have transfer pricing issues. A lot of people, what is that? You know, and there, you know, that's basically interrelated companies. You know, you're transferring services between entities. Well, there's a market. There should be a markup on that. And so there's a lot of corporate taxation issues like transfer pricing and these other issues. There's employee tax, there's withholding, there's visa and immigration. Like, are you going to send as an organization someone to work in a foreign country illegally? They need visa and documentation, you know, all set up prior to them going. And these are all considerations that the organization has to consider. You go back, these are some of the individual things that need to be considered, and the entity considerations they also have to consider. Assignment documentation. Probably the best thing as an organization you can do to establish a global mobility program is to organize, you know, how this works, and having proper documentation. How do I find out about my workforce, whether they're even working in a foreign jurisdiction or not? These are all types of issues you have to consider. One of the biggest issues that comes up immediately, and I mentioned this earlier in the presentation, was how do I pay these people? So there's global payroll issues you've got to consider, because you might be employing a US citizen from the US, but they're living and working in Spain. Well, Spain wants their withholding on their income that they're earning there. How do you do that? These are all types of questions organizations can do. These are policies that we can set up to help you organize this, and a global mobility policy to help you organize all your different type of assignments and so on and so forth. And how do you address these various issues that remote workforces create? This is a life cycle of an international assignment. There's a lot to this. So when you have someone start an assignment, what does that look like? Well, you identify them, you know, you figure out the cost of them, of their assignment. You have to set up payroll. There's social security taxes you've got to consider. There's some tax planning for pre-arrival the individual needs to do. There's a lot of different things. There's all the various aspects of payroll that have to be done. Most of this assignment life cycle is done at it's pre-assignment. So before they even go on an international assignment, you have a lot of work as an organization to do up front. And as you develop a global mobility policy, how do you you've got to get in front of this before they even leave on assignment. So, you know, you got to have policies in place within your organization to kind of identify these people before you find out, you know, 6 months down the road that they're already in country working. And so this is where the policy kind of helps, and this is where kind of this life cycle, understanding this and how it works, is also helpful. And I think I'm going to turn the time over to Lucas to kind of talk us through the rest of the global mobility considerations.
Thank you, Jared. And as Jared mentioned, company policy, it really is the main foundation or the building block of the rest of your global mobility program. Everything else will rest on it. And as the company enters into this Second Amendment agreement, which it provides the details of what the role of the individual is, how they'll get paid, as again mentioned by Jared, whether they'll be equalized, what the employer will provide, what kind of benefits, if any, while individual is on the assignment. Again, as I mentioned earlier, then equalization, that's essentially ensuring that individual is no better or no worse off while they're on international assignment. So that policy, again, it's done once the company policy is determined, and once the company decides if the individual would be tax equalized. Company manages payroll, which may include shadow payroll. It's not always required, but it may be necessary. It needs to decide where the individual will be paid. Are they going to be paid from the home country or host country? What currency? Given the, will there be an adjustment for the currency? Will the company adjust once a year, twice a year for the changes in the exchange rate? So it's, again, as Jared mentioned, a lot of it takes place prior to start the assignment, and the tax return by the individual is just a really small piece of the whole of this whole pyramid, as you can see, which is done all the way at the end, most likely after at least part of the year was done on international assignment. Not to say it's any less important. All these steps are important, but it's one of the last steps. Again, this is the last slide on the company policy, so I won't bother you with it anymore, but it's such a big part of the global mobility program. It answers who's the economic employer versus who's the legal employer during the assignment. What happens with the employee at the end of the assignment? Will the employee come back to their home company through their home base, or will they be required to localize? Can the assignment be extended? Will the individual be required, again, to localize at the end, or would they be returning? Also, it allows for the control of the budget of the assignment once all these questions are answered. Allows also to control the exceptions, as we know, the exceptions to the rule can drive up the cost of such international assignments. So having a policy in place, this will allow organization to control the cost ahead of time as well. The assignment letter, which was also mentioned, the assignment letter is essentially a contract between the employer and the employee. So this would reference the assignment benefits that are extended to individual while they are on the international assignments. It also ensures that individual is compliant as from the tax perspective, as well as also from the risk management, as it impacts all key areas of the organization. So it is, again, it's really, it answers the key questions that the employee is most likely wondering about before they go on the international assignment, as well as it ensures for the employer the tax compliance and the risk management of this assignment. Now, I think a lot of organizations struggles with this part is essentially identifying who is part of the global or remote workforce. Granted, obviously some organizations have it under control, but and because of the type of assignments that we see these days, which are, a lot of them are less formal and a lot more frequent, I believe it seems from what I've seen, what we've been exposed to, that a lot of organizations do struggle with this part, trying to figure out when does individual start to be a remote worker, or how often does he have to work elsewhere in order to trigger a residency, or maybe trigger a tax compliance issue in a given location? And I feel this is especially true for individuals traveling within, for example, in the US, between different states for short period of times. However, those could accumulate to a large number of days in a given state, and effectively may cause a filing obligation, a tax return filing obligation in that state for individual, or even for the company. So it is really important to determine or to start tracking that those individuals that will, or that are currently traveling a lot between different states, or if to determine if they will trigger such occurrence. Now, in terms of the withholdings, I think we're all aware with the form W4 that we all have to complete when we first start to work anywhere in the US. Now, this form allows us to estimate the amount of withholdings that would be done on our wages, on the compensation that's paid to us. Now, the company remits or deducts and remits taxes from the employee's income, and the employee can set this withholding amount, or it can change the withholding amount by completing a W4 form or state W4 equivalent form. Now, withholding is based upon the place where they work and where their work is actually performed, and not necessarily based on the residency if they're different. For example, for U.S. individuals, if U.S. individuals are working outside of the U.S., they actually will be exempt from the federal withholdings if they're subject to withholding, income tax withholding by a foreign jurisdiction. And the W4 would need to be completed and kept by payroll on file to show that in case there is a payroll audit, the payroll would have an argument or a substantiation of why they're not withholding income tax for this particular individual who is on international assignment. And here's just a reference to what I mentioned earlier regarding potential trigger of state filing requirements in different states. As you see, there are 24 different states that require registrations for withholding merely based on 1 day of work in their state. That's a lot of states, 24. There are some states, obviously, that have reciprocity agreement. Again, that would need to be examined more closely. And best way to track it, one way would be to include, to implement the protocols that track or that match the time spent or in a place that they work, individual work, with the expense reporting that they are submitting for reimbursement. Just one way to tackle that problem, depending on how big your organization is. That's something to think about. I know we're only seems to have 5 minutes left, so I'll have to speed up a little bit. Again, regarding the remote workers, they owe taxes to the jurisdictions where they work from, regardless of the employer's location. Myself, I'm currently working out of Connecticut, even though I'm assigned to a Salt Lake city office. So I'm a good example of that, where my taxes are being withheld and remitted to the state of Connecticut, even though my employer is physically in Utah. And again, if the employee is working in the jurisdictions other than their principal jurisdiction, and they reach that jurisdiction threshold number of workdays, if such a threshold has been adopted for withholdings, then their jurisdictions will be required to withhold. Now, Social Security is one of the obviously one of the requirements for individuals to fund as well, to be withheld from their wages. And generally for the expats being paid from the US, they will continue, individuals will continue to be subject to a US Social Security withholding. Now, depending on the country that in US individual is going on international assignment to, or a foreign national is coming to US on international assignment, depending on the country combination, there is a totalization agreement that US is engaged in with a number of countries. I believe that country is close to 20 these days, which allows individuals, which prevents essentially double Social Security withholding or participation or paying double Social Security. So individual could, if they're coming from a qualified jurisdiction that the US has a totalization agreement with, individual can obtain a certificate of coverage for up to 5 years that allows them to continue participating in their home country Social Security program, as opposed to participating in the host country program. And as mentioned on this slide, it does not apply to Medicare benefits nor the unemployment taxes. It only applies to Social Security taxes. Now, depending on the country combination, of course, some countries do have higher Social Security tax withholding than others. One that comes to mind is France, where their Social Security withholding is 25%. So it's not always beneficial to individual to remain in their home country, although it has to be taken into this Social Security withholding and payment and participation in the Social Security program must be taken as a whole and examined as a whole. Obviously, that impacts individuals later on benefits when they retire. So we'll have to again examine that when on the individual basis. Just in summary, just a short checklist regarding the global mobility programs. Please identify remote work employees population and implement tracking of their time. Ensure there's a policy in place that's really key in the global mobility program. Assignment letters should be executed, should be signed by the employee, and consult with your trusted tax advisor prior to sending individuals on international assignments to ensure they're not adversely affected by double taxation or deferred compensation or taxation of income that's not recognized as qualified by the US. And I think that's all I have. Sorry for taking you over time.
There was one question that we wanted to address live, which was the use of 1099 employees in foreign jurisdictions. I think as a general comment, in the US, we have contractor versus employee considerations that the IRS looks to for making sure that the treatment of the contractor versus employee is correct. I will say cross-border, we have similar considerations. Just labeling somebody a 1099 contractor does not alleviate the considerations if they're doing employee type work. It's something to consider and look at. If they're truly a contractor, then there are consequences to that. If they're truly an employee, there are consequences to that. So it's not a cure to the problem. It's something to consider, and contractors can be easier if they're truly contractors.